Hello and welcome to this edition. In this edition, we will discuss about a new section in the Income Tax Act introduced by Finance Act number 2 of 2024. That is section 194T. It deals with TDS on payments to partners by firms. Now, what are the key points that we need to understand in this regard? Actually, in the current scenario, until the Finance Act 2 of 2024, no TDS is deducted by partnership firms or LLPs in respect of payments to partners. The partners may be paid various nature of incomes like interest, remuneration, salary, bonus, commission, etc. So till the introduction of this once section 194T, there was no TDS in respect of payment to partners. Now, what will happen in this scenario? These emoluments of the partners are not captured in the annual information statement or tax information summary of the partners. Now, what may happen in this scenario? It may so happen that firms make these type of payments to the partners whereby they will claim deduction, and it may so happen in certain cases the partners may not include those incomes in their return of income. Therefore, such income is escaping assessment, and thereby the government is at a loss of revenue in this regard. Now, actually, previously, certain income tax authorities, what they have tried to do is they claimed that TDS is to be deducted under Section 194H of the Income Tax Act in respect of commission paid to the partners. And in certain cases, the department is of the view that TDS ought to have been deducted on the remuneration paid to the partners as under section 192 of the Income Tax Act. But in these scenarios, the appellate authorities have struck down the intention of the assessing officers, and it has been specifically mentioned by the appellate authorities that 194H is not applicable to commission paid to partners, and also TDS cannot be deducted under Section 192 of the Income Tax Act in respect of salary or remuneration paid to the partners. So, in order to overcome these issues, what the Finance Act 2 of 2024 has done is has introduced a section called 194T in order to address the loophole of income escaping assessment in respect of emoluments paid to the partners. The effective date of this amendment is 1st of April 2025. Now, what is the scope of this section 194T? Now, it will apply to certain payments made to the partners. That is, payments like salary, remuneration, commission, bonus, interest. So, these five type of payments are covered. Now, what is the rate of tax prescribed by Section 194T? It is 10 percentage. And what is the threshold limit? 20,000 rupees is the threshold limit. We will discuss further about all these points as we progress. Now, what is the main objective or purpose for which this section 194T is introduced in this statute book is to ensure proper reporting and taxation of payments made to the partners. This is the main intention behind introduction of section 194T. Now, this section 194T places an obligation on the firm. So, the partnership firm which makes the payments to its partners is an under obligation to deduct TDS. Now, what is the definition of the firm as per Section 2 of the Income Tax Act? A firm includes LLP, formed and registered under the LLP Act in India. Therefore, this 194T is also applicable to LLPs. However, it is applicable to only Indian LLPs. So, foreign LLPs are under no obligation to deduct TDS under Section 194T. Now, here, payment made by a firm to its partners. So, who is the deductor? Deductor is the firm. And who is the deductee? That is, who is the payee? Payee is a partner. Now, a partner will include a working partner or a non-working partner or a resident or a non-resident. All are covered. And also, as per Section 2 of the Income Tax Act, a partner includes a minor also. Therefore, minor payments to minors is also covered by Section 194T. Now, what are all the amounts that we have already discussed? Salary, remuneration, bonus, commission, interest. Now, what is the rate of TDS? Rate of TDS is 10%. If the payee happens to be a resident, then 10% TDS is sufficient. If the payee happens to be a non-resident, then the 10% is to be increased by surcharge and cess also. What is the time of deduction of TDS? The TDS is to be deducted at the time of payment or at the time of the credit to the account of the partner, be it a current account or a capital account, whichever is earlier. That is the time at which the TDS is to be deducted. I repeat, at the time of payment or at the time of credit, whichever is earlier. Next comes, we will discuss a little bit more about the threshold. The threshold is 20,000 rupees in a financial year. Now, one may get a doubt whether this 20,000 is individually applicable to each type of payment, like for remuneration 20,000, for interest 20,000, for bonus 20,000. No, it is not like that. All these type of payments total 20,000 rupees in a particular financial year. If all these emoluments up to 20,000 is paid in a financial year, no TDS. If it exceeds 20,000 rupees, then the liability for TDS arise. Now, certificate of lower deduction or no deduction provisions are not applicable in respect of Section 194T. PAN number is compulsory for the payee or deductee. If PAN number is not provided, higher rate of TDS will be applicable as per Section 206 AA. And also you have this 206 AB, wherein if return of income for the last 2 years are not furnished and the amount of TDS exceeds 50,000 rupees, then higher rates are to be deducted. Now, these provisions are very well applicable in respect of Section 194T also. Now, coming to the applicability, from which date this section is applicable. This section is applicable from 1st of April 2025. Means from the financial year 2025-26 onwards, this provision is applicable. Let us take a scenario wherein for the financial year 24-25, interest is credited on 31st March of 2025, but it is paid in the month of April 2025. Whether TDS is applicable in this scenario? No. TDS is not at all applicable in this scenario. Only the interest, salary, commission, bonus, remuneration, etc. relating to financial year 25-26 onwards, this provision is applicable. Next, what are the obligations of the firm? We very well understood that the deductor is the firm, and as per the definition of the term firm, a partnership firm is included, and as well as a LLP is included. But foreign LLPs are not included. They are under no obligation to deduct TDS under Section 194T. Now, this provision is applicable to partnership firms, whether they are assessed as a partnership firms or whether they are assessed as a AOP. That also we should understand. And also, there is no distinction between a working partner and a non-working partner, as well as the TDS under Section 194T is concerned. Foreign LLPs are not required to deduct TDS under this Section 194T. Now comes a question where, now let us suppose interest to partners. Generally, it is understood that interest to partners is allowed under Section 36, read with Section 40B. And the income tax authorities are of the view that remuneration to partners is allowed only under Section 40B, but not under Section 36. Now, let us examine a scenario where interest is paid to a partner and a TDS is not deducted under Section 194T. So, in that scenario, Section 40 small a comes into play. It implies that if interest is paid to partner and TDS is not deducted, then as per Section 40A of the Income Tax Act, 30 percentage of such interest paid will be disallowed, and it will be allowed in the year in which the TDS has been deducted and remitted to the government. Next comes the question whether if TDS on remuneration paid to partner is not deducted, will Section 40A come into play? Now, my dear friends, Section 40 small a and Section 40 small b both are non-obstinate classes, but each one of them does not override the other, right? Now, many income tax authorities opine that the remuneration to partners is deductible under Section 40B of the Income Tax Act. Therefore, 40A does not apply if TDS is not deducted on remuneration paid to a working partner. However, this issue will not arise in respect of payment to a non-working partner, because payment to a non-working partner itself is not allowed as deduction under Section 40B of the Income Tax Act. Therefore, non-deduction of TDS does not erase another disallowance that we need to keep in mind. Next comes, these are the case laws under which the department is of the view that the interest and remuneration are allowed as per Section 40B of the Income Tax Act. Next comes certain practical implications. So, what are the practical implications in this regard? We have to ensure that TDS is to be complied with in respect of all the payments from 1st April 2025. In order to ensure proper compliance of Section 194T, you have to maintain accurate record of all the payments which are made to the partners. And the partners should ensure that whatever emoluments they have received from the partnership firm, if they are chargeable to tax, they have to include in their returns of income so as to avoid any further penalties. Now, the tax auditors need not report non-compliance of Section 194T in the financial year 2024-25 and also the tax audit reports of financial year 2025 because these provisions 194T are applicable from financial year 25-26 onwards. Now, let us discuss about the interplay between Section 195 and Section 194T. Now, let us say a partner happens to be a non-resident. A partner happens to be a non-resident. Now, already we have a Section 195 wherein it says that any amount paid or payable to a non-resident which is chargeable to tax in India, then tax at appropriate rates have to be deducted under Section 195 of the Income Tax Act. Now, a question arises if a payment is made to a non-resident partner. Let us say remuneration is paid to a non-resident partner. Now, TDS under which section it has to be deducted? Will it have to be deducted under Section 195 or will it have to be deducted under Section 194T? Now, what are the jurisdiction or what is the jurisprudence in this regard? Generally, if there is a potential conflict between two sections, then both sections hold equal weight. Then what you have to do? You have to apply the doctrine of harmonious construction. Doctrine of harmonious construction. So generally, what is this doctrine of harmonious construction? It is a legal principle to avoid conflicts between statutory provisions. There should not be any conflict between the statutory provisions. We need to ensure that both the sections, section 195 and 194T, are to be given effect. It does not mean for the same payment TDS is to be deducted once on 195, TDS is to be deducted once on 194T. It is not like that. TDS will be deducted under only one section. Okay. So, what this section 195 is with regard to the residential status, and this 194T is with regard to the income specific payments. So, in order to avoid conflict, one may go for TDS under section 195 to non-residents and TDS under section 194T for residents. But it may so happen that in certain cases, this payment may be not chargeable to tax in India by virtue of DTA. Now, in those circumstances, section 195 is not applicable. In such a case, you may go for section 194T of the Income Tax Act in order to comply with the provisions of the Income Tax Act. Okay, and moving forward, we will discuss another issue with regard to this TDS under section 194T. Now, let us say a partner of a firm is paid remuneration of rupees 5 lakhs in a financial year. But as per section 40B, only 4 lakhs is deductible in the hands of the firm. Under section 28 of the Income Tax Act, remuneration received by a partner from a firm is chargeable only as business income only to the extent to which it is allowed as deduction in the hands of the firm. But however, Section 194T does not state that TDS is to be deducted only on that sum which is chargeable to tax in the hands of the partner. It does not say like that. It says that whatever payment is made to the partner, TDS is to be deducted. Now, in this situation, if the firm deducts a TDS on 5 lakhs, and if the partner is offering only 4 lakhs as income under the business by virtue of receipt of remuneration from the partnership firm, then it may lead to a potential mismatch because the TDS return will show 5 lakhs, but the partner will offer only 4 lakhs as income. Now, the CPC may issue mismatch notice. So, certain uh, additional columns may have to be introduced in the schema of the written form in order to avoid this potential mismatch. Next is generally most of the firms decide upon their remuneration based on the finalization of annual accounts. It may so happen that the remuneration may not be known until the books of accounts are finalized. Now, in such a situation, this may lead to non-compliance with the partnership firms. So firms have to be careful in this regard and ensure that the partnership remuneration is decided well within the time by which you need to deduct TDS so that non-compliance is not attracted. And also, as already discussed, it is effective only from 1/4/2025, means from the financial year 2025-26 only, or you may say for all the payments from previous year 2025-26 only. In respect of those payments only, Section 194T is applicable. To conclude, why this Section 194T is introduced? To plug a gap in the tax reporting as well as tax compliance by the partners. So, it may so happen the partners may not be offering the payments received from the partnership firm in their return of income. So to plug this loophole, this provision has been introduced. And also, if this provision is not complied with, the SSC means the director, means the firm or the Indian LLP may have to face disallowance as well as penalties. However, this section 194T has multiple challenges as far as the payments to non-residents is concerned, whether it has to be deducted under section 195 or 194T, or with regard to the mismatches, let us say firm has paid 5 lakhs, but only in firm's hand 4 lakh is allowed, and the partner is offering only 4 lakhs as an income, but his AIS or 26 AS reflect 5 lakhs of rupees, and there is a um, chance that the partner may get a notice with regard to the mismatch. And finally, the firms should ensure that accurate accounting and TDS compliance is made, and if necessary, the partnership deeds may also require an amendment to comply with Section 194T of the Income Tax Act. Thanks for watching. See you next time.